Welcome back to the lab. We were just about to play detective with Wilson Company's inventory. Check out this timeline I drew. We have the value on November 4th, but we need to travel back in time to October 31st. We have to reverse every transaction that happened in those 4 days. We start with that 483,700. That number comes straight from the first paragraph of question 6.6. Now look at point number 1 in your materials. It says goods costing $38,400 were received from suppliers between November 1st and November 4th. Since those goods arrived after October 31st, they were in the warehouse on November 4th. But they weren't there on October 31st. To get back to the October 31st balance, do we need to add that 38,400 back or subtract it from our starting number? Boom! You're thinking like an auditor. If it wasn't there on Halloween, it doesn't belong in the Halloween count. That 38,400 comes from point 1 in your materials. Now, check out point number 2. It says goods that cost $14,800 were sold for $20,000. Again, this happened in those 4 days after the year ended. On November 4th, these goods were gone. They'd been sold. But back on October 31st, they would have still been sitting on the shelf. So, to get back to the October 31st count, should we add back the cost of those goods? And follow up, which number do we use? The $14,800 cost or the $20,000 selling price? Wait, let's slow down and look at the timeline. On October 31st, the day we care about, those goods were still in the warehouse, right? Because they didn't get sold until November. See the logic? If they were on the shelf at the end of October, but gone by the time we did the count in November, we have to put them back in our calculation to get the October total. And you were totally right about the number. We used the cost of $14,800 from point 2, not the selling price. So, does it make sense now why we add those back? Exactly. We're putting things back on the shelf that were sold after our target date. Good. Now let's look at point number 3 in your materials. A customer returned goods that were sold in October. They cost $400 and were returned in good condition. These goods were back in the warehouse on November 4th because they'd been returned by then. But on October 31st, they were still with the customer. So, for the October 31st count, should we include these in our inventory? Or should we subtract them because they weren't in our building yet? You nailed it. On Halloween night, that box was in the customer's hands, not our warehouse. So even though it was on the shelf during the November 4th count, it wasn't there on October 31st. The 400 comes from the cost mentioned in point 3 of your materials. Last one, point number 4. Wilson Co. returned goods that cost $1,800 back to the supplier in those 4 days. On November 4th, these were gone, sent back to the supplier. But on October 31st, they were still sitting in our warehouse. What's the play here? Add them back or subtract? I see your logic about the payable decreasing, and you are totally right for the accounting entries. But for this question, we're just counting the boxes in the warehouse. Since we didn't return them until November, those boxes were physically sitting on our shelves on October 31st. In the November 4th count, they were gone. So to get back to the October count, we have to add them back. The 1800 comes from 0.4 in your notes. Now we just need to do the final math to get the October 31st value. If you crunch those numbers, what's the final answer for closing inventory? Aha! I think we are looking at 0.4 differently. Let's reread that line together. The company here is Wilson Company, us. We sent the goods back to the supplier. We bought them in October, but we didn't ship them back until that small window between November 1st and 4th. So, on October 31st, before we decided to send them back, those $1,800 worth of goods were sitting in our warehouse, right? They only left our warehouse when we returned them in November. So to get back to our October total, we have to add them back in. Does that clear up the confusion about who had the goods? It's an ADD. Since those goods went out in November, they were in during October. So we add the 1,800 back. Give that calculation a shot. What total do you get? Nailed it. 461,500. That is exactly the last option in your multiple choice. I put a summary for this one on the board too, so you can see where every single number came from. The key takeaway for Wilson Co. is that we are reversing time. And here are your flashcards for the road. You crushed both of these. How are you feeling about inventory valuation now? All right, RMJ, let's lay it all out. Here is the full breakdown of every number and where it lived in your materials. For 6.4, the key was ignoring the 160,000 and 125,000 sales prices. We only used the cost per unit from the purchases. For every number was points 1 through 4 in the list. The most important thing here was using cost and reversing the flow to get back to October 31st. I've dropped those 3 flashcards at the bottom for your revision. How are you feeling about these 2 problems now? Any other part of the homework you want to hit? All right. How to crush this in an exam. You have to be like a detective looking for specific trigger words. If you see a date for the inventory count that is different from the year-end date, that's your biggest hint that you're doing a reconciliation problem. And remember, if you're going backward in time, you reverse the normal logic. Purchases get subtracted and sales get added back. I've whipped up some flashcards for you to review later. How's your confidence feeling with these two types of problems now? Nailed it. That is the perfect way to look at it. In question 6.4, we were moving forward. We started on May 1st and counted through the year. So we added what we bought and subtracted what we sold. In question 6.6, we had the answer for November 4th and had to undo the last 4 days to get back to October. So the logic flipped. Does that time machine logic make both questions feel a bit more connected now? Boom. You've got this now. You are spot on. In these inventory valuation questions, you should treat the selling price like it is invisible. It is a total distraction. The only time you would ever care about the selling price is if the question mentioned that the goods were damaged and we had to value them at their net realizable value, which basically means the lower price we could sell them for. But in these standard FIFO and reconciliation problems, skip the sales price every time. See how we did that in both problems? In 6.4, we ignored those big six-figure sales numbers.